All right, let's get started with booking January. Again, our first order of action is to book the initial funding for this corporation. Now, this specific funding is initial deposit of $200,000 by the two owners. Now, not all of it will be essentially an equity investment. And the reason for that is, again, when you make an equity investment in a corporation and later you take money out of the corporation as an equity, it creates a little bit of additional complexity. However, if, for example, your initial funding is a combination of equity and debt, the debt could be repaid, right? And repayment of debt is a very typical transaction. So again, nothing too unusual. So that's what we'll do here. So again, debits and credits, right? We always will cover this. And again, for this specific season of DeCre Accountancy Group simulation, we will cover payroll, we will cover billing, and we will cover debits and credits behind them. This initial one is, again, it's initial deposit to fund the corporation to get going. So let's start with the easy stuff. The money is going to our general account, right? General account is in assets. Assets, what do? For them to increase, they have to be debited. So let's go ahead and put the 200,000 right into the debit column. What else happening here? Well, we need to make sure credit's equal to our debits, right? So to achieve that, we have to distribute it accordingly. Like I said, not all of it will be going to the equity, but part will, and the equity will be, in this case, capital stock, right? Because it is a corporation. Now, capital stock, in this instance, again, we have two owners. In this specific instance, again, all of that would be documented, and it's not on this necessarily deposit receipt. We just happen to know it, all right? So let's say that it is, 10% of this amount. So $20,000 is essentially the stock, and it's equally distributed, so it's 10,000 each, right? They own stock worth of 10,000 each, and the rest essentially becomes the loan from the shareholders, right? And that's a liability. All right, and that's 180,000. So what happened here? All right, we know that bank account is an asset, and assets go up when debited, right? So therefore it is debited right here, 200,000. We also know that capital stock is an equity account, and equity goes up when credited, right? And it did go up. What else? Well, part of it was equity, part of it was a loan from shareholders, right? So that, when the corporation is due to repay this loan, and in this instance, let's say this loan is due in 2 years, and it would accrue interest, let's say at 5% annual, and that's something that will be booked as the year-end adjustments, right? Because they're not actually paying it out in the first year. So again, we will document all that. Meanwhile, 27,100 is an account called loan from shareholders. It's a liability. Liabilities go up when credited, right? So right here. So let's go ahead and book it, right? So in this specific instance, again, we go to banking. It's been a while, right? Make deposits. Here it is. We're going to make sure that the date is correct, because even though all these transactions covered 2021, we're not in 2021 when we're filming it. So again, always double check the date. And again, we'll make this simulation more or less kind of semi-live mode in this instance. However, again, we got to watch the date. So in this instance, the date is January 4th. So 01/04/2021, right? It's a deposit. So let's call it funding 01. Again, it is deposited to general account. Very good. And it's received in our instance, it's received from the owners, right? So we're going to put their name, Lebahang and Reyes. Right, they're the owners. What is the account? So we actually should do them twice here, because we will. All right. And one of it, you know, we have it right here. It's capital stock. And let's say 50%. It's probably it was checked, right? So again, 10,000. And this is also capital stock. 50%. Let's say it's they're $1 a share, right? So let's say it's 10,000 shares. Right. And the rest is debt, right? Again, we have it right here. So it's loan from shareholders. It's going to be split equally, right? And again, people ask me, you know, what's the best way to book something like that. Again, loans are slightly easier to take out because it doesn't impact the equity, but you could do it either way. I mean, either way works really. And again, there are people also do convertible debt, so that's another option. But we're going to do it this way. So again, let's take a look at this transaction and make sure we understand our debits and credits, right? What's happening here? Well, we have this 200,000, right? Here it is. It's being deposited to our bank account. Bank account 10100 right here. It's our Bank of Lakes general account. So it is being debited, it goes up. What else is happening here? Well, we also have to credit things, right? So that our debits and credits always equal. So 20,000 is credited, right, to our capital stock account. So the corporation sells that capital stock in exchange for that 20,000. And 180,000, right, that's credited to loan from shareholders. So our liabilities go up when credited, and therefore the corporation now has debt of 180,000 to shareholders. Anyway, we're good to go, right? We're going to go ahead and save and close this one. It's transactions 90 days. Yeah, we can turn off this notification, and we will. But again, when you are actually booking and, you know, live mode, this is a good reminder by QuickBooks to tell you that, hey, is your date correct? So yes, it is correct. All right, so we booked that successfully. Again, this is just January. That is our only deposit at this time because, again, we haven't started the operations really. We haven't performed any work. We haven't built clients. In February, it will get much more interesting, much more exciting. So again, please subscribe, please stay tuned, and it will be very interesting season. Thank you.